9 things you need to know about your thrift savings plan. Welcome to Your Federal Retirement Benefits with PSRE, where you get the advice and information you need to make the most out of your federal retirement benefits. My name's Jeff Betcher, fiduciary, financial planner, and federal retirement advisor. And today we're going to be talking about the 9 things you need to know about your thrift savings plan. And before we go any further, please like and subscribe. Your support means everything to us. Let's talk about what the thrift savings plan is. The TSP is what is referred to as a defined contribution plan. That's very different than a defined benefit plan. Defined contributions, as the name would suggest, you are defining how much you're going to contribute to the TSP. Defined benefit, you are defining how much you're going to receive in the future. So the defined benefit plans would be something analogous to your pension, your FERS or CERS annuity. Defined contribution plans, 401ks, 403bs, and again, the TSP. Number 1, federal employer matching contribution. Your employer is going to contribute 1% to your TSP, regardless if you contribute anything or not. Now that's the case at least for FERS employees. So for FERS employees, the federal government, regardless if you do anything at all with your TSP, has an automatic 1% contribution. The federal government will match a maximum of 5% of your salary, but that requires you to actually participate also. Now, the way this technically works, if you contribute 5, the federal government will have contributed a maximum of 5. That includes the 1% they've already contributed as a mandatory, obligatory 1% contribution. So the federal government's 1%, then they match your next 3, the federal government will have contributed 4. So your 3% contribution equates to a 4% federal employer match. And then the subsequent 2% you contribute, the federal government's going to contribute 1/2 of that contribution. Suffice it to say, all the math aside, if you contribute 5, your employer is going to contribute 5. Give yourself a pay raise, make the contribution. Number 2, contribution limits. The IRS has imposed and defined TSP and all qualified plan contribution limits. So depending upon the year in which you are making the contribution, the IRS will publish a contribution limit related to individuals below and above age 50. Above age 50, you have what is referred to as a catch-up contribution. So depending upon your age, the IRS will define either a standard contribution limit, that's how much you can contribute, the 5% match is in addition to that, and also then the catch-up contribution. Now the IRS does also impose a maximum contribution limit that is both yours and a federal employer or really any employer match. But suffice it to say, your contribution limit is defined by the IRS. You're going to find those links to present day TSP contribution limits by clicking the link in the information below. Number 3, don't out-contribute the TSP. What you're going to find is that for those individuals who are aggressive savers, you do have the capacity to contribute more than the IRS maximum. It's not going to benefit you. The IRS mandates that any contributions in excess of the maximum amount be refunded back to you. The amount refunded to you is, of course, taxable. So the simple way to do this, if you want to hit the maximum, is simply take the IRS prescribed max, and again, check out the link below, find the IRS max, and divide it by the number of payments you have over the course of a year. Bi-weekly, twice a month, what have you. So you identify the maximum and you can set that dollar figure as a contribution limit. So you can set, for instance, 5%, 3%, whatever the number happens to be, or you can preset a defined value that you're going to contribute. Simple mathematics. Number 4, special rules for combat zones. Now this is only for military members who are serving in tax-free zones, for tax-free combat zones. So therefore, it's not applicable to most individuals. However, it is good to understand those individuals who are serving in these tax-free combat zones, fantastic opportunity for you, combat pay, and also then a much, much larger contribution limit. Those contribution limits, as they do with all TSP contributions, they're going to adjust every year. So check out the link below. It's going to take you right to the information you need to know in terms of how much you can contribute. Suffice it to say, if you are one of these individuals that qualify, please do consider increasing your contribution limit. It's a phenomenal opportunity. The 5% match continues from your employer. Your contribution limit increases substantially. Increased contributions, of course, in the future suggest increased benefit. Number 5, let's talk about distributions. Now, the distributions come in several different forms and fashion. You can take a lump sum distribution, a partial distribution, you can take installment distributions. Now, the names are all going to be pretty much self-explanatory. Lump sum distribution, you're taking the lump sum of your TSP and moving it out. We'll talk about the tax implications here in a second. 2, partial distribution. Well, imagine you have a $400,000 TSP, for instance. A partial distribution would be any amount, not including all $400,000. Partial. Installment payments. The installment payments are, again, as the name would suggest, you are fixing a dollar figure and they're going to pay you, they being the TSP. The TSP is going to distribute money to you on a periodic basis, monthly, quarterly, annually. You get to define the amount. Now, let's stay on the topic of installment payments for a moment. Installment payments, as you might imagine, the risk there is that you set a dollar figure that erodes principal. So imagine for me for a second, let's take $100,000 and you fix an account of, say, $5,000 per year in distributions. And we'll keep the math easy and call it a one-time payment. If your $100,000 is invested in the stock market and we have a terrible year that year, and the $100,000 declines to $80,000, for instance. Well, so you're in the C fund, S fund, whatever it happens to be, the portfolio declines in value, and then you also receive a distribution. Well, your $100,000 didn't just go down with the market, it went down with the market, and then the distribution took place. Do that 2 years in a row. $5,000 out of $100,000, you might perceive that and say, well, I should be just fine. It's a smaller percentage, and over time, I anticipate that this amount might be something we can trust that the performance in the market, performance in the TSP is going to outpace that. Different philosophies on that, not today's topic. The point being is the market goes down, you take a withdrawal, market goes down again. And that has happened, obviously, multiple years of negative performance. And all of a sudden, a second distribution, 100,000 to 80, hypothetical market decline, $5,000 distribution, you're now looking at 75,000. 75,000 minus 20%, well, that's 15,000. So your 75 becomes 60. And then the 60,000, another distribution. Now you're at 55. In 2 simple years, you've gone from $100,000 to $55,000. Now imagine what percentage $5,000 is of 55,000. It's in excess of 9%. Now the portfolio has to generate 9% every year just for your principal not to erode. That's a scary place to be. So if you're going to engage in installment withdrawals, you have to, 1, identify how much you can safely withdraw. And this is where a federal retirement advisor is crucial. Really, any distributions from your TSP recommendation, you should be talking to a highly rated, highly respected federal retirement expert. There are going to be plenty of financial planners in the world, very smart people. The difference being between an individual that specializes in federal benefits and an individual that doesn't, the rules that apply to federal retirement benefits that only a federal retirement expert is truly going to have a firm understanding on. Simple answer, find the guy that truly specializes in federal retirement benefits. Almost certainly in the end, it's going to pay dividends. So back to the installment payments, making a distribution or making an installment payment, and making that decision, you're going to have distributions that run the risk of eroding principal far earlier than you anticipate. We're going to stay on this specific topic for a few minutes. And the reason being is because this is really what the TSP is all about, taking withdrawals. We're not talking about how much money you can save, we're talking about how much money in the future you can create in income. So installment payments, as we just described, run the risk of you depleting principal too early. It also runs the risk, of course, of, well, you could have had a greater level of lifestyle or greater quality of lifestyle in retirement had you taken out more. It becomes a balancing act. So the installment payments are fine. And for those individuals who have amassed a very large sum and you have muted expenses, you can simply designate a fixed amount, leave in the portfolio, invested in the C, S, I, lifestyle funds, G fund, what have you. However, most individuals, when they analyze post-retirement income and post-retirement income strategies, installment payments versus the IRA, look at an IRA. Covering the topic of partial or lump sum distributions, the thing to remember here, probably the most important, is distributions, if they are not made into an IRA, if they're not rolled over into an IRA or additional qualified plan, comes with a heavy tax burden. Let's go back to the $400,000 hypothetical TSP. Take all $400,000 and put it in your checking account. You just gave yourself a $400,000 taxable income. And you pay taxes based on that $400,000 of income plus any other earned income for that calendar year. A partial distribution, those rules apply equally. $50,000 coming out of your TSP into your checking account, well, you've now added $50,000 to your taxable income for that year. So be very careful about how you take those distributions. Now, any of those dollars can be rolled into an IRA. Now there's penalties, IRS penalties for individuals who are taking distributions prior to age 59 and a half. So be mindful of that. Work with an expert, work with a federal retirement advisor to find the answers there to make sure you're not gonna be negatively impacted there. But after 59 and a half, in-service distributions, while you're still working, in-service distributions allow you to take funds out of your TSP, roll it into a qualified plan or otherwise, no additional IRS penalty while you're employed. After employment, the rules are much more free. You can roll over or withdraw at any point in time. Again, be mindful of the prior to 59 and a half rules. Be mindful of whether you're rolling those into an IRA or qualified plan, qualified annuity, or into your checking account. Checking account's not considered a rollover. It's going to create the tax implication. Rolling it over postpones those tax implications. You also have the opportunity to buy what's referred to as the TSP annuity. Now, I will never make a blanket recommendation, certainly not in YouTube, or certainly not on a podcast, but I'm going to tell you this very plainly. The TSP annuity is arguably one of the worst things I think you can do with your TSP. I've never met a human being where the TSP annuity is the best answer for them. Never one. And I've been doing this a long time. Not to say that there's not an individual where the TSP annuity makes all the sense in the world. I just don't know who that human being is. Now, the TSP annuity, what it does, you are purchasing a private market product from MetLife. Now, I like MetLife. MetLife's a great company. I'm a fan of Snoopy. That being said, you're taking your entire savings out of your TSP or a percentage of, and you are giving up ownership and control. You're transferring ownership to MetLife. They now own and control your TSP. There are provisions for the TSP annuities, ways that you make withdrawals, ways that you can guarantee some level of ongoing payment even after you die. But in a worst case scenario, take this $400,000 hypothetical account balance, all $400,000 moved into a TSP annuity. MetLife owns that money. Now, fast forward, let's say 6 months, and there's a tragic car accident, and the owner of that TSP is no longer with us. That $400,000 is not the spouse's, it is not the kids. That $400,000 theoretically could be owned, part and parcel, owned by MetLife. And any future benefit sacrificed to the owner or their family, all the money is gone. Now, that also being said, the cash flow the TSP annuity generates, traditionally not very competitive. The reality is that a private market, what's called a SPIA, single premium immediate annuity, that's effectively what the TSP annuity is. It is MetLife's TSP government, so there's no competition, there's nobody else but MetLife doing this. So take the funds out of the TSP, buy the annuity through the annuity or through the TSP's vendor, that's MetLife, and MetLife guarantees a cash flow for the rest of your life. That sounds great, and if you live to 120, fantastic, but the MetLife product, compared to a private market, MetLife being private market, compared to other private market products, as a general rule, everyone that I've found, we have the ability, we or other advisors, you have the ability to increase that long-term cash flow, to increase the guarantee. Maintain control, increase cash flow, possibly do that and also create some potential growth. Suffice it to say, there are alternatives to the TSP annuity. If you're considering that, if you feel good by saying, I'm gonna have a lifetime income and that feels really, really good, I can understand why it would. The TSP annuity is not gonna be your best option, probably 9 out of 10 times. I can't say absolutely definitively never, but again, I've never run into a circumstance in which the TSP annuity beat all other competitors. So at least do yourself the favor and get out there and talk to a federal retirement expert and just say, here's what the TSP annuity is gonna pay me. Can you find something better? Then the math is what it is. Lastly, related to distributions, The TSP traditionally takes anywhere between 30 and 60 days before you're going to get any distributions at all. So you're going to submit paperwork and it might take up to 60 days before distribution. That also does not include if you are retiring, your employer is probably not going to notify the TSP of your termination of service or end of service for another 60 days after you leave. So add that math up. You retire on January 1st. It might be March 1st before your employer even notifies the TSP, and then another 60 days after that before you receive your first payment. It is possible for 4 straight months after retirement that you have no access to any of the money in your TSP. Be careful, plan in advance, talk to a federal retirement advisor to make sure you've done all the paperwork correctly, and just make sure that you aren't stuck in a position where you don't have access to the money that you need. Number 6, how is a TSP different than other qualified plans? Well, there are really 3 main things. Your employer match, the very low administration fees, and the TSP automatic contributions. Now, a lot of 401ks will have something similar, but the TSP really does shine bright, if you will, in terms of administrative expenses. So let's talk about all 3. The TSP automatic contribution. You're going to receive 1% from your federal employer. So if you're making $80,000, you're going to receive $800 regardless of your participation in the TSP. So no matter what, you're going to get a contribution. 2, you have up to a 5% match. Now, the 1% contribution, automatic contribution, and the 5% match, if you compare those against 401ks across the board, there are companies definitively that are more generous. There's an awful lot of companies that are far less generous. So the TSP really is a great plan in terms of a wealth building plan. And of course, the TSP administrative expenses, the TSP fund administrative expenses are, as advertised, historically very, very, very low. Be mindful of the TSP mutual fund window. The costs to contribute money in through the window, if you're not contributing a large enough sum, the fees to contribute to the window, the fees for that purchase price, or the cost structure, the commission earned by BlackRock, by Merrill, that dollar figure to make that contribution, it can be a substantial percentage of the amount that you contribute to. So just be mindful of that if you're going to go in that direction. Just be intelligent and make smart decisions. Number 7, the types of TSP accounts. There are 2, Roth TSP, traditional TSP. The primary difference, when do you want to pay taxes? Now, to describe the difference, let's use $100,000 of current income. Jane Doe, federal employee, makes $100,000. She chooses the traditional TSP. She chooses a 20% contribution amount. Her $100,000 less the 20%, 20 grand. The $20,000 is deposited into the TSP traditional. She only pays taxes on the $80,000 that's residual in her income. The $20,000, all $20,000, gets deposited into whatever allocation she has inside her TSP, and those funds grow with the market or however the funds are invested. John Doe, on the opposite side, he chooses the TSP Roth. He also makes 100 grand. His $100,000 is reduced by the 20% contribution he makes to the Roth TSP. Now, for both Jane and John, the 5% contribution, 5% match, that's the 5% of the $100,000, that's equal. Both Jane and John make the same $20,000 into the account and they invest it exactly the same. The difference being is that Jane, again, had $80,000 and is only taxed on the 80 grand. John, on the opposite side, is taxed on all $100,000. $20,000 goes into the TSP, the $80,000 residual. However, the tax burden is this year. The $80,000 is reduced by Uncle Sam's assumption that he made 100 grand. Now that might seem punitive. Why would you take taxes today versus be Jane's solution and not pay any taxes? The benefit being, of course, is that depending upon John or Jane's age, what you're going to find is that this $20,000 in either account, in the future, Jane's account, 100% taxable. So if Jane's account over time grows from $20,000 to $80,000, she now has $80,000 of taxable income in the future. John, on the opposite side, he puts in $20,000, but it's a $20,000 in a Roth TSP. His $20,000 likewise compounds to $80,000 over many years. They have an identical investment portfolio. The growth is identical, but John doesn't have taxes due. So his $80,000 is now tax-free. Jane paid taxes only on 80 grand. She was not taxed on the $20,000 of contribution. John paid taxes on all 100. So he paid taxes that year at $20,000 more than Jane did. However, his $80,000 in the future is 100% tax-free. Depending upon tax rates, both today and when they take it out, John has the opportunity to have a lot more income after tax than does Jane. A lot of federal employees will probably do a contribution and do a little bit of both. You have to look at your circumstance and understand what is referred to or commonly referred to as tax diversification. Well, diversification, the word is pretty obvious, multiple things. Tax diversification really boils down to how is your future income taxed? Your Social Security is going to be taxed. Your pension is going to be taxed. Any money coming out of your TSP traditional is going to be taxed. So your TSP Roth is not. So it's possible, depending upon your future income, that you're going to look at the TSP Roth and make a decision that in the future you want the opportunity to selectively identify which account you want to pull from to then take control of those future tax implications. The Roth TSP is a great opportunity to do so. A Roth IRA, a much lower contribution amount. TSP Roth, a much higher contribution amount. Future income, TSP Roth, Roth IRA, the future income on either is going to be tax-free. Number 8, taking a loan from your TSP. Taking a loan from your TSP is a lot like taking a loan from anything. You're borrowing the money. You're going to have to pay it back. Now, the manner in which the TSP charges you interest is based on the interest rate or the going interest rate at that time. The interesting thing about taking a loan from your TSP is that you're literally borrowing from yourself. So it's an interesting way of looking at how to access funds. The best thing to do here, again, talk to a federal retirement expert to make sure that it's a withdrawal or a loan or what have you, which one's going to be best for you. It's a very individual set of circumstances. What is not individual is the manner in which the TSP allows you to take the loan. As a for instance, you have $100,000 in your TSP, $60,000 is the Roth TSP, $40,000 is the traditional TSP. So you have a 60-40 split. How the funds are invested, C fund, I fund, F fund, what have you, the TSP is going to allow you to take a withdrawal, and out of the box, it's going to be proportional. That is proportional to the funds you own and proportional to the tax treatment you own. So again, $60,000 in your Roth, if you take a $10,000 loan, $6,000 of that loan is going to come from the Roth. $4,000 of that loan is going to come from the traditional. You can designate, and again, based on the circumstance that you believe is going to be most advantageous for your individual circumstance, you can designate either the Roth or the traditional as where you want to borrow money from. Go back to tax diversification. Which account do you want to grow faster? Again, based on your future income tax implications or anticipated income tax implications, you may choose to leave more money in the Roth and only borrow from the TSP traditional. Not a recommendation, it's very personal. Talk to your advisor, but you do have a way of looking at this to make sure that you're doing what is best for you and your family. Number 9, the TSP funds. G, F, C, S, and I. The TSP funds are managed by a company called BlackRock. It's a 49% owned by Merrill Lynch. So effectively, your funds in the TSP are managed by Merrill Lynch. Massive investment company, obviously. Now, the TSP funds run the spectrum from very, very safe, the G fund, guarantees, all the way to I, international, a lot more risky. Depending upon your anticipated length of hold, depending upon your risk tolerance, depending upon the amount of growth you need to achieve your goals, you're going to have a combination between the G, F, C, S, and I, any one or a combination thereof. So to talk about the individual funds, the G fund. The G fund are governmental securities. So the G fund is comprised of governmental securities, U.S. Treasuries, and effectively the G fund is the TSP participants loaning money to the federal government. It's not a bad thing. The reality is that any purchase of a treasury is the owner of that treasury lending money to the federal government. In the aspect of the G fund might be the single greatest aspect of the TSP. It's federally insured, cannot go down in value, and pays a very, very, very attractive guaranteed rate. Now let's talk about what guaranteed rate and attractive is. It's traditionally not going to keep up with inflation. So if inflation is 4%, the G fund is likely to pay less. Inflation is 9%, as it was in 2022, the G fund is almost certainly going to pay less. Reference point there, 9.1% Wall Street Journal stated inflation rate, 4.5% TSP G fund. 9 in inflation, 4.5 in the G. Now, it's liquid, it's federally insured, can't go down in value. All of those things are great, but the cash flow on the G fund is going to be impeded, if you will, by the increase in cost of living. So if you're going to invest in the G fund, and bizarrely enough, something like 45% of all money in the TSP is invested in the G fund, almost half. $750 billion, half the money's in the G fund. The G fund doesn't keep up with inflation. So the G fund is a very attractive thing with the TSP, liquid, good cash flow, relative terms, but be very mindful if you're going to leave it there for a long period of time, inflation is going to erode purchasing power. The TSP F fund. The F fund is a fixed income mutual fund. It tracks the Barclays Aggregate Bond Index. Now, the principal value on the F fund is going to traditionally adjusts based on the movements in the interest rate market. Bond prices go up, interest rates decline, or the flip side of that, interest rates are rising, bond prices are likely to decline. So be mindful of owning the F fund and the risks associated with that. The F fund, more secure than, traditionally at least, more secure than the C, S, or I, more secure than many of the life cycle funds, but the F fund does not come without risks. The yield is traditionally relatively muted over the long run, and you do have a fair amount of interest rate risk, which is, as interest rates rise, again, the principal value of the F fund is likely to decline. The TSP C fund. The TSP C fund is effectively tracking the S&P 500. The great part about the TSP C fund is the expenses, very low. The negative thing about the TSP C fund is, without any thought process at all, it's just tracking the index. Now, when the market's going up, tracking the index can be a very fruitful thing. However, traditionally, the index, S&P 500, is 500 stocks. The S&P 500 does not discriminate between those stocks that are profitable, owning companies that are profitable, versus those companies that are losing money. So if you think about the philosophy there, you're just owning 500 of the biggest companies in the country. Okay. The economy's growing, everything's booming. C fund, S&P 500, likely to grow. In rougher times, and recessions happen, rough times happen, markets decline, in one of those instances, you're owning 500 companies without any concern for whether or not those companies are actually making money and whether or not they're going to be healthy in the next recession. The next recession's coming. Is the C fund going to be the best answer? The TSP S fund. The TSP S fund are small and medium-sized companies, approximately 2,000 of them, that have not been listed in the S&P 500, therefore not in the C fund. These smaller companies represent about 20% of the total stock market value. Traditionally, the S fund is going to be more volatile than the C fund. So you're going to have more good times and then more bad times. So if the market goes down, the S fund's probably going to lose faster. Market goes up, S fund, historically speaking, might grow also faster. The TSP I fund. The TSP I fund, historically speaking, has the highest level of growth of any of the TSPs, or any of the TSP funds. The TSP I fund, I being international, comprises from large companies or larger companies out of 22 developed nations, not the United States. Again, greater level of volatility than the other TSP funds, certainly the G or the F, but also greater levels of volatility than the C or the S fund. The I fund, historically more volatility, you hope for greater rates of return. Not always going to be the case. All right, so now for some questions from the audience. Can I roll my 401k from my old job into the TSP after becoming a federal employee? The simple answer there is yes, you can. You may want to consider, however, rolling those funds into an IRA. The IRA has more options. Now, not more options don't necessarily mean you're gonna pick the best option, but it does mean you have more choices. So you have the S&P 500 index, you have the Barclays aggregate bond index. You can get those things in an IRA. You can get them inside the TSP, but inside the IRA, you have thousands and thousands of other options. So yes, you can. Why? How do I figure out the percentage or fixed amount I can contribute? So Mike, the way you do this is effectively you look at the IRS maximum contribution amount. How much does the IRS allow you to contribute? That's gonna be a calendar year thing. Year in, year out, it adjusts a little bit. It's a arithmetic function. So if you can contribute, say, $23,000, you divide that by the number of months, you divide that by the pay periods, there's your number. And so I'm not gonna give the answer now because that number, the IRS maximum contribution amount, that changes every year, but it's a fairly simple equation. Again, maximum contribution amount divided by the number of contributions you're gonna make that year, there's the fixed amount you would contribute or to get to the maximum contribution allowed by the IRS. Can you use your TSP from MyPay, or is it an entire other program? Well, the MyPay and TSP are two different programs, but yes, you can use the MyPay to set your contribution amounts and things of that nature. So you can access it in two different ways. You're gonna get to the same result. You can influence how much you contribute, things of that nature, through either applications. Thanks for watching. And if you have questions or comments on the episode you just watched, comment in the section down below. We're gonna add your comments or answer your questions in future episodes. And as we build the channel, like, share, subscribe. Your support means everything.